I have a number of companies in my portfolio, all of them in different categories and different sectors. And then I also have a number of companies on my watch list that I keep a close eye on. And in this episode, I want to go over 5 dividend companies that I think are a complete steal right now. These are companies that I think I've sold off too much. And I know this is a departure from the majority of content you're going to get today. When you go on to CNBC or other YouTubers, this is what they're going to talk about. Recession fears, the market falling, the housing bubble, inflation, on and on and on. What most of them won't talk about are potential deals in the market right now, but that's likely the best thing that we can do. During every significant downturn, the investors that kept a level-headed approach and continued to buy even through the massive volatility we're seeing were the ones that were rewarded on the other side when the market eventually recovers, because it eventually will recover. That will happen. I have to remind people of that all the time. When the market's going up, it doesn't continue to go up forever. When the market goes down, it doesn't go down forever. It'll eventually bottom and recover. This market has been crazy. Just from Monday, I'm down $10,000. So we went from $10,000 in the green to now $5,000 in the red, and every single day it's bouncing back and forth. As of right now, we're up just a hair today, up $1,000. So we'll see what happens, but rather than focusing on the day-to-day price swings and whether I'm 20,000 in the green or 10,000 in the red, I think it's a much better use of our time and opportunity here to buy high-quality dividend-paying companies. Now, the tool that we're going to be looking at this with is called Qualtrim Insights. This is a tool that I've built from the ground up. It includes the dip finder, which is something that shows you what companies are in a dip and by what technical extent, meaning which companies are trading below or above their 200-day moving average. As you can see right now, with the passive income portfolio, literally every single company in this portfolio is in a dip. All of them. Not a single company has upward momentum. That's a clear indication that we are in an overarching bear market. Every single company I own is dipping down to some extent. Now, we also have another tool here called Qualtrim Track. On Qualtrim Track, the portfolio page here shows you a lot of aspects of your portfolio, including your upcoming officially declared dividends. So I can see Texas Roadhouse is going to be paying me $140 on the 24th of this month. Then T. Rowe Price on the 29th, and then June 30th, I'm getting dividends from Domino's Pizza and Pepsi. And then if we look at another chart here, we can see my monthly income from dividends. You can see it continually grow basically every month. We've had a couple months where it goes down, but overall, this is trending upwards. For the past 3 months, I've had above $500 in dividends every single month. And I want to grow this as quick as possible. Selling out of some of the higher yielding assets, like my covered call ETFs, have brought this down a little bit, but I want to bring this dividend income up as much as reasonably possible, especially during times like this, when prices come down, yields are high, and the market's giving us great opportunities. And one thing that I do want to mention is literally no company in my portfolio has cut their dividend. In fact, the last company to cut its dividend in my portfolio was Disney, and that was in March of 2020. So that was 2 years ago. So there's been no dividend cuts in my portfolio. All these companies are doing great. And in fact, most of them have been raising their dividend, not cutting them. So even though it's a little bit disheartening that the stock market's coming down, my portfolio, for example, is down 21% year to date. That's right in line with the S&P 500. That's not fun to see. At the start of the year, I was close to $400,000 in value. Now we're at 306. And that can be incredibly discouraging if you don't have the right mentality. But the truth is, you should be wanting the market to go down if you're still buying stocks. If you're no longer buying stocks, if you're retired, then you don't want the market to go down. You just want to protect gains as much as possible. But if you're young, if you're buying stocks, if you have 10 years to invest, you want the market to go down. And this was the poll that I asked on Twitter. If you have a magic wand and you could pick if the market went up 50% or dropped 50%, most of you, the majority of you, 61% of you said you wish the market would go down an additional 50%. And that is the right attitude. The decisions you make right now determine whether or not you build wealth during the next bull market. So having said all of that, let's go ahead and jump into the 5 dividend companies I'm buying. Now, before we jump into the first company, I want to go over the key attributes we're looking for here. The first one is robust profitability. We are looking for profitable companies that have high amounts of free cash flow, high amounts of net income. And this might seem like an obvious one, like a given, but this isn't really obvious in this market. Many investors invest in companies that aren't free cash flow positive, especially when you factor in stock-based compensation. Around 40% of the current stock market is not free cash flow positive. So 40% of companies are not profitable. We're not only looking for profitable companies, We're looking for ones that have robust profits. The next thing that we're looking for is conservative reinvestment and high payout. I'm not looking for companies that are in reinvestment mode, that are reinvesting all of their money back into the company for employees and marketing and sales and growth and so on and so forth. I want companies that don't need to reinvest all of their money. I want profitable companies that have a high payout, meaning they give me their excess returns. So we're actually not looking for companies that reinvest all of their profits back into the business. And I know that's contrary to what a lot of investors look for. They want companies that reinvest aggressively. But over time, the companies that really do well are the ones that operate efficiently and they have a high payout to investors. So I'm looking for return of capital. I want companies that make not only robust profits, but they return those profits to me, the shareholder. And they do that in the form of dividend. And that brings me to the next thing we look for, which is a higher yield. I'm looking for dividend yields that are above 2.5%. Now, after that, we want companies that are undervalued. That means that they're trading well below their historical average and they're trading undervalued relative to the rest of the market. So both in absolute terms, they're just low valuations, and in relative terms to the rest of the market. This low valuation will give us a margin of safety. And then the final thing we look for is low debt, which we compare to the EBITDA. A lot of people like to compare debt to equity, but that doesn't make sense because equity is not what pays for your debt. EBITDA and the free cash flow is what pays for your debt. So we want low debt relative to EBITDA, and the preference would be to have the total debt be less than 3 times EBITDA. Now, the first one that we can look at is Target. So go ahead and search it here. And like I said, many people have questions about this website here. This is called Qualtrim Insight. It's a tool. It's a suite of software we developed for our Patreon members. So if you haven't tried this out, go ahead to the link in the description, join the Patreon, and you get access to Qualtrim Insights, the Dip Finder, Qualtrim Track. You get access to a Discord community and exclusive videos and lots of content. All of that is included in the Patreon. There's no upgrades or upsells or advertisements, anything like that. And people love this tool so far. We have over 2,000 Patreon members using this tool every single day. So if you haven't tried it, I think you're missing out. And it does come with a free trial. Now let's go ahead and take a look at Target and why I think this company is so cheap. First of all, the company's down 38% year to date. And last month, they had a 30% drop in stock price in a single day. And this is for issues that I think overall are very temporary. They had a mismatch in what they ordered, the type of items they ordered for their store, and what demand shifted to. Demand shifted to groceries and soft goods, and Target ordered a lot of hard goods. Because of that, their operating margins and profitability this year are going to be lower, and so their earnings revisions are revised downwards. The stock price crumbled, and now we have a great company over the long term trading at a temporary discount. The forward PE ratio is at a 15, which is lower than the S&P 500 and lower than the average that Target trades at for the past 10 years. Normally, this company trades at a 17 to 20 PE ratio on the low end, and sometimes it gets up into the 20s. A 15 forward PE is historically low. If we look at the metrics of this company, all of them look pretty decent. Target grows their revenue on a relatively consistent basis. It's been through periods where it's flat, but that's okay. It's continued to grow. We can look at the EBITDA, which is a proxy for their earnings, and likewise, this has gone through some dips, but overall, it continues to grow. Target management has been very good on their execution. We can look at the free cash flow. This is how much money the company has at the end of the day after paying for all of their expenses. And Target is a free cash flow company. They print a lot of free cash flow on a consistent basis every single year. Most of the time it ranges from $3 billion to $4 billion in free cash flow. 2021 was an outlier year. I don't really expect this to be repeated every year. That was $7.8 billion. But overall, I think they'll continue to print at least $3 to $4 billion in free cash flow per year and grow that over time. And then if we look at the net income on a quarterly basis here, it paints a little bit of a story. We have moderate growth in net income over a long period of time. Then 2020 happened, the stimulus happened, and Target was a huge beneficiary of that. People decided when they have discretionary money, they want to spend it at Target. So you can see the net income go up like crazy. But either way, this is a company that has robust profits. Now let's go ahead and take a look at the balance sheet here. We can look at the amount of debt they've had over time. Target always carries a decent amount of debt, especially during these low interest rate times. They've been leveraging their debt to expand. Now, if we look at the cash balance here, they've used up a lot of their cash over the past year, and they're down to $1.1 billion in cash as of last quarter. And meanwhile, they have $16 billion of debt. So they do have a lot more debt than cash, but we want to compare their net debt to their EBITDA. Last year, they had $9 billion of EBITDA, so their debt is well within that 3 times EBITDA range. It's well covered by their cash flows. Now, of course, we want to look at the dividend history of this company. Again, we want companies that don't have to spend all of their money on reinvestment. I want companies that will pay me, the shareholder, a big part of their profits because they don't need it to run the business. And Target's certainly one of them. Because they have such consistent free cash flow, consistent EBITDA, they can pay a growing dividend. And you can see this over time. Look at this dividend growth. It's incredible. Target is one of the best dividend paying companies in the market, bar none. And they're continually raising their dividend. They have been paying a 90-cent dividend per quarter, which is already really high. And that's what the forward yield here is based off of. But Target just announced again that they're raising the dividend by 20% to $1.08. This is another 20% raise even during the time of crisis for Target. Even after their stock price falls 30%, they're raising their dividend. That is a huge confident boost from the management team. They're signaling to the market that this is temporary. It's not something they're concerned about in the long term, because they would not be raising the dividend if they were concerned about their long-term future. Right now, Qualtrim says that the forward dividend yield is at 2.93%, but that's based off of the historical 4 quarters. So on a forward-looking basis, it's going to be 20% higher, above a 3% starting yield today for Target. And on top of that high yield for this company, the payout ratio is relatively low. They have a 27% payout ratio. So they have a lot of wiggle room to raise this dividend a lot in the future. And by raising it by 20%, they're not putting their company in jeopardy. So far we have a company that's sold off because of temporary concerns. They're growing their revenue, their EBITDA, their free cash flow, their net income. They have a lot of debt, but it's completely manageable by their cash flows. They have a growing dividend that is well above other companies right now. Now, the last thing we want to look at is shares outstanding. And this is very simple. If this chart goes up over time, that means the company's diluting you, decreasing your equity stake in the company. And they're most likely doing that to pay for stock-based compensation, expenses, or acquisitions. So you can be the judge of if those are a good thing, but for highly profitable companies like Target, I want to see this chart go down over time. And that is exactly what I'm seeing. As they do share buybacks and reduce the amount of shares outstanding quarter after quarter after quarter, that makes it so that I own more of the company, so that one share of the company is a bigger percentage of the pie. And you can see that they're doing share buybacks continually every single quarter, even up to the last 6 quarters. So far, this is why I list Target as one of the companies that I'm buying right now. I'm adding to this company. It has growing revenue, EBITDA, free cash flow. It has manageable debt. It has an incredibly fast-growing dividend, and it's trading at a historically low PE ratio. If we go into a recession, of course, the price might drop a little bit more. That's a possibility, but I'm looking at the long term, the next 5 to 10 years. And I think that Target will not only make it through a recession, but I think they'll be completely fine during one. They made it through 2009, and they're better equipped now to deal with the recession. So in my opinion, this company's a buy. Now, the next one that we're going to look at as a company that I'm buying currently is Starbucks. I continually dollar cost average into this company because I think right now it is undervalued. And this is one of the most troubled companies in the market, according to the media. They have the problem of inflation, of unions, of China closures. They have a triple whammy causing the stock price to come down 40% year to date. In fact, over the past 5 years, even though the business and the fundamentals have expanded geographically across the world, they've opened up tens of thousands of stores, they've increased their free cash flow and profitability. The company's up 17%. It's obviously going the other direction than what investors want. It used to trade at a high just last year of $126, and now it's down to $70 a share. This is an incredible decline for a brand name like Starbucks and a company that has the history of Starbucks. Let's go ahead and look at a couple metrics here. The forward PE is a little bit above the S&P 500 at a forward 20.8 PE ratio. But I don't think that's something investors should be concerned about. Normally, Starbucks trades in the high 20 ranges, low 30s. So this is historically one of the lowest PE ratios this company's ever traded at. And on top of that, this is with China closures. When China opens back up fully and those 5,000 plus stores there get running to full capacity, the earnings will go up, causing this PE ratio to go down, making this company appear even cheaper. So I think this company is much cheaper than it looks. If we look at the growth of the company, we can look at it annually here. Starbucks is a growth company. Not only is it a well-established, profitable company, but look at this revenue growth. They're growing very consistently. The only time they've ever taken a hit was in 2020 when people were literally locked down. Even in 2009, during the Great Recession, the revenue went down for 1 year and then it started to rapidly recover as they continued to open up more stores. The reason the revenue went down is they protected their balance sheet, they stopped store openings, and they just wanted to make it through the worst of the recession. So the capital allocation of this company has been great, and the growth historically has been great. The EBITDA growth looks very similar to the revenue growth. That's what we want to see. That means the company has decent margins. And Starbucks, of course, is a free cash flow company. They're highly profitable. Last year, they made $4.52 billion in free cash flow. And typically for the past 5 years, they've made over around $3 billion. The net income of the company has also been very consistent and growing over time, so they are a free cash flow and profitable company. Now, of course, we want to look at the balance sheet of the company, and the primary goal here is to make sure the company won't get in trouble if we do go into a recession and their earnings go down. Right now, Starbucks does have a lot of debt. That's one of the downsides of this company. They have $4 billion in cash, and they have $21 billion in debt. So they have around $18 billion of excess debt. Now, if we compare that to their EBITDA, last year they made $7.35 billion in EBITDA. So their net debt to EBITDA is still within 3 times, even though it's a little bit close. But it's still within 3 times EBITDA, which means they do have some wiggle room and they'll likely make it through any economic challenge coming up. Now, of course, we want to look at the dividend history. This is something we're looking for as companies that have that high dividend yield and that great dividend history. Since 2010, Starbucks has raised their dividend from 7 cents per share per quarter to 49 cents per share per quarter. So they've multiplied that dividend to a huge extent. This is rapid dividend growth from a highly profitable and growing company. And the dividend right now is at a starting 2.6% yield with a 50% payout ratio. So they can only really grow the dividend if they continue to grow as a company, which I fully expect them to do. But the payout ratio is a little bit on the high end, so they don't have as much wiggle room to increase the dividend without growing their company. But still, it's yielding well above the market average. Now, one of the things Starbucks did is they announced that they're cutting off their share buybacks. So they're no longer doing share buybacks because they're under pressure from the unions. They want to do some more reinvestment back into employees and training and trying to get a better relationship with their employees. And I view that as a good thing. The CEO of Starbucks is very convinced that he can get a better return by investing back in the employees right now than paying for share buybacks, which I kind of agree with to some extent. So I think that even though right now the share count is going to stay relatively flat, I think the money being spent to build a better relationship with the employees of Starbucks is money well spent. So overall, looking at the fundamentals of this company, I don't overthink it. We have a great company with great brand value, selling at a heavily discounted price because of what I consider to be temporary issues. Meanwhile, the revenue's growing, the EBITDA is strong, the free cash flow is strong, the dividend payout is very high, 2.6%, and it's growing because they're going to continue to grow their dividend. And I think all these factors working against Starbucks makes for a compelling entry point right now to buy the stock. Now, next up, we have JP Chase. This is one of the big 4 banks. It's my favorite of the 4. And there has recently been some chatter, some talk about different startup companies and fintech companies like Square and PayPal and Block, and how they're going to disrupt and destroy the big 4 banks like JP Chase. Now, while JP Morgan is down 30% year to date, we can go ahead and look at some of those companies that were supposed to disrupt this company. We have Square down 65%. It turns out that all the people saying that the big 4 banks were going to be disrupted and destroyed by all the startup tech companies, all the fintech companies, they were completely wrong. And I thought they would be wrong the entire time. They are not going to destroy the big 4 banks. And if you think they are, you likely don't fully understand the breadth of what these companies do. The amount of investing, wealth management, the amount of tech that they have behind them, the amount of money that they use is astronomical. And these other companies are simply not in a position to be able to compete with them. Now, JP Morgan is on sale. The company is down 30% year to date. Over the past 2 years, it's up 15%, but you can see it went up to 166 at one point. Now it's fallen back to 113. And the company's never been better positioned for the future. It has a 4 PE ratio of 10. We can look at that with banks, but I think the most important valuation metric here is price to book. It currently trades at a 1.3. Now, I will say that out of the 4 banks, Bank of America, Wells Fargo, Citigroup, and JP Morgan, JP Morgan is the most expensive. The most fundamentally cheap bank of the four is Citigroup. And that's why Warren Buffett and a lot of other investors are buying Citigroup. Now, having said that, I still choose JP Morgan over Citigroup only because I think the bank is just higher quality. It has better diversification, better tech, and I think it has a better growth path. So even though JP Morgan is more expensive than the other four banks, I still think it's at a discount. Now, there's a couple important things we want to look at with banks. The price to book is certainly one of them. 1.3 is historically low for JP Morgan. The revenue growth is strong with this company, meaning they're getting more deposits. They're growing their overall revenue. The dividend yield of the bank is currently 3.5%, which is at a point that I recently highlighted. I would really start looking at buying this bank again. 3.5% forward yield that's well protected is something that I see as very attractive. And they're going to continue to grow that yield over time because JP Morgan has a long history of growing their dividend payments. And on top of growing that dividend over time, they're also doing share buybacks. You can see the amount of shares outstanding going down over time. And the big thing that people are worried about with a company like JP Morgan going into a potential recession is can this bank survive a worsening credit environment where people can't pay back their loans? And the answer to that is yes. This company is very well equipped to survive any type of recession we go into. They're well equipped to go into a terrible 2009-like recession, even though that's somewhat unlikely looking at the numbers right now. But even if we do, they'll still be able to survive it just like they did in 2009. They are better equipped now to go into a worse environment than they were back then. So in my opinion, this company's a buy. Now, the number 4 dividend paying company that I'm buying currently is one that's just getting crushed in today's market, and that's T. Rowe Price, and it's being crushed for very specific reasons. Now, before we jump into this, I have to give a quick shout out to today's sponsor. It's FTX US. I'm sure you've heard about this company. They're one of the largest US regulated crypto exchanges. They're also sponsoring a lot of celebrities and personalities like Tom Brady, Kevin O'Leary, Steph Curry, and even the Miami Heat Arena is called the FTX Arena now. And they're also well backed. Even though there's a lot of chaos happening with cryptocurrencies right now, FTX is one of the most stable companies. They recently just raised $400 million at a $32 billion valuation. Now, my viewers know that I'm not big into cryptocurrency. It's not my thing. I don't do really any research on them or cover them because I like buying these dividend paying cash flow producing assets. But FTX is a platform that's moving into a lot of other categories. One of them is stocks, and this caught my interest. They are building out a stock platform that offers free trades. You can buy and sell anytime the market's open. There's no payment for order flow, and it's incredibly simple to use. So this is what I've been using. I've been testing it out. It's currently in beta. They have thousands of users testing it right now, and the stock portion of this platform is going to be open to the public in the coming week. So sign up now. There's a link in the description of this video. It literally takes 2 minutes to sign up. It's completely free. And if you put in the code Carlson, the referrer code Carlson, my last name, you'll get $10 credited to you after depositing $100. And once you sign up, let me know what you think of the platform. So far, I've only had good feedback. All right, now back to the video here. We have T. Rowe Price. This is a company that I have kind of mixed feelings on, and let me explain it. This company right now is very attractive to dividend investors because it has an incredibly high forward yield. It's at 4.36% with a 35% payout ratio. So it's a very high dividend yield with a lower payout ratio that's well covered. And the company's trading at a very low valuation of a 10 forward PE ratio. And the company's come down in price by 45%. So this looks like an attractive dividend paying company that has a well-covered dividend, a low payout ratio, a low valuation, and on top of that, if we look at their balance sheet, they don't have a lot of debt. In fact, they have almost no debt. They have $200 million in debt and currently $2 billion in cash. So they're cash rich. They can continue to operate their business, pay their dividend just with their cash balance. So everything kind of checks the boxes with T. Rowe Price. On top of that, the company's grown tremendously over the past 10 years. They're highly profitable with growing EBITDAs. Their free cash flow is also very consistent and growing over time. So everything on the fundamental historical looking basis looks good with this company. But here's where I have one word of caution for T. Rowe investors. T. Rowe is primarily growth funds. That's what they specialize in. And the market has moved rapidly out of growth funds into value funds, into dividend funds. And as the market's done that, T. Rowe's assets under management have gone down substantially. It went down again last month to $1.4 trillion. They say May's slump was highlighted by assets under management in equity US mutual funds of $424 billion compared to $435 billion in the previous month and $554 billion in December. So month over month, their assets under management is going down, making it so the company earns less money. Because the primary way that T. Rowe Price earns money is through fees on their assets under management. Less assets under management means less earnings. And you can kind of see that happening if you look closely. Just last quarter, their revenue went down a little bit. That's the first time it's gone down in some time. The last couple of quarters, as their assets under management have gone down, so has their EBITDA. So you're starting to see this company become less profitable over time, which is a concern. And this is something that will continue as long as they have falling assets under management. And this is the primary reason why, even though I look over all these fundamentals and I am buying some T. Rowe Price, it's not a company that I would pour my life savings into. I do think there's some risk here depending on how long this rotation lasts. Because if we move out of growth stocks for a year, then this would be a fantastic buy. If we move right back into them soon, this would be a good buy. But if this sell-off lasts for 3, 4, 5 years, and investors don't move back into growth stocks for 5 to 10 years, then this company will struggle. So it's kind of how you see the future. I'm still optimistic. I'm still bullish that investors will want to get back in on growth stocks. But I think this is going to be a very difficult time for T. Rowe Price until inflation comes down, until interest rates start to stabilize. Up until that point, this company's stock price will probably continue to trend downward. So keep that in mind when you're buying this company. Now, on top of paying their growing dividend over time, which they're a substantial dividend grower with these special dividend payouts infrequently, they also have been doing share buybacks. So they're not diluting you, they're doing share buybacks over time. So overall, I think that T. Rowe Price is a compelling buy in this market, but it does come with its kind of warnings. Analysts are forecasting a decline in earnings over the next 2 years. So earnings are projected to go down. Analysts don't really know how long they'll go down, and that depends on how the market behaves. If the market recovers relatively quick and investors become more risk on and they want to buy risk assets like growth stocks, then this company will do better than expected. If this rout in growth stocks continues for the next 5+ years, then this company will likely struggle even more than it is today. So a lot of that is up to the judgment of the investor and what you see in the future. But right now is a pretty decent time to buy the company if you think things are going to turn around within the next couple of years. Now, next up, we have one of my favorite companies ever, which is VICI. And I know this company's been in my portfolio for a while. I talk about this company a lot, but that's because I still love this investment and I'm buying more of it. I like the whole concept and idea of real estate. Owning rental apartments, owning property, renting it out, and collecting a paycheck every single quarter in the form of a dividend. How much more simple can it get, and how much more predictable can your cash flows get? With lots of companies are looking at robotics and genomics and artificial intelligence and competing with different companies with high technology, with VICI, you don't do that. You just own some properties, you collect your huge rent checks, and they pay that out in cold hard cash every single quarter in the form of a huge dividend. That is a predictable, easy cash flow from a business. And I love that concept. Now, a lot of people criticized me recently for trimming my VICI position by $15,000 right on the 6th. So on the 6th of June, I sold $15,000 of VICI on the basis that I saw a rapid expansion in the multiple, going from $26 a share to $33 a share in the course of just a couple weeks. And I thought there was a high likelihood this would not last. This was investors becoming a little bit too excited too quickly, and I took $15,000 off the table just to preserve those gains with a high degree of confidence that I'd be able to re-enter the position at a better valuation. And that is exactly what happened, albeit quicker than expected. Immediately following that sell, the stock price started to go down rapidly, down to $28 a share. Now it's trading right around $28.70. And I've almost purchased in my entire sales. So that $15,000 that I sold, I'm back in the stock, but now at a lower cost basis. My yield's higher and I own more shares. And I will face no tax consequences of that sale because I recently sold out of an ETF at a loss. So that will offset any tax consequences of this sale. Now, let's go ahead and talk about VICI and where it stands right now, because they had a lot of catalysts play out and I want to go and revisit those. Here's an interview just a couple days ago of Ed Pitoniak, the CEO of VICI, going through all the recent accomplishments that VICI has done.
Just over 4 years since our IPO. We've grown markedly during that period. Our market cap when I first started was $4 billion. Today it's over 30. We had a couple dozen properties. We're up to 43. We owned only one property on the Las Vegas Strip. Today we own 10. We got elevated to investment grade in late April in conjunction with our MGP closing. And this S&P 500 inclusion is yet one more step in that institutionalization, giving us even greater access to capital and a greater opportunity to capitalize on growth opportunities in experiential real estate.
Do you see what this management team has done over just the past 4 years? These guys are all-stars. They're doing great things with this company at a very rapid pace, and they're doing it for the benefit of the shareholder. His whole goal, his entire task is to try to get very attractive returns for the investor, which Ed Pitoniak himself has outlined as 12% annualized returns for any investor in VICI. That is their long-term objective and their long-term goal through a combination of dividend payouts and capital appreciation. And as you can see on the chart right here, VICI has outperformed the S&P 500 year to date. Even since this recording, the S&P 500 has fallen a lot more. So the gap between VICI's performance and the S&P 500 has even widened. Now, one of the questions Ed gets asked is one of the similar concerns that many investors in VICI or potential investors have. And that is, what is the downside of this company if we go into a recession? What if people don't go to Vegas quite as often? This is specifically what Ed Pitoniak gets asked, and here's his response.
You own the land, which is critical. You own the buildings, which is critical, but you operate none of it.
That is absolutely right, Tyler. And it's good to see you after so many years. We do not operate any of it. Our operators own the operating risk. They own the downside, but they also, very importantly, own the upside, the entirety of the upside, which we are very happy for them to have. They've worked very hard through COVID, and now they are thriving in a wonderful way that they deserve.
Ed highlights the risk and reward of VICI. VICI does not have the same downside risk as a Caesars Palace or MGM Grand Casino. They don't own the downside. If those companies struggle, they still have to pay VICI. And if they can't afford to pay VICI, they have to take out more debt, they have to manage their business, they have to do different things to pay VICI. So that rent is due whether or not they want to pay it. But the upside also doesn't belong to VICI as well. If MGM and Caesars have record sales and revenue and profitability, they're not going to pass that on to the landlord. So VICI is insulated to a large extent from the performance of the individual operators that are their tenants. And as long as they can pay their rent, which they're well covered right now, VICI will continue to collect those paychecks. In the instance that I think is a very unlikely instance that something like Caesars Palace couldn't pay rent even by borrowing more money, then likely they'd have to be bought out by a different company, which would end up paying VICI rent either way. So either way, being the landlord of these assets and not the operators makes it so VICI is one step removed. They have much more predictable, much more reliable income and cash flow than the individual tenants. I think VICI is one of the most unique real estate investment trusts because of the uniqueness of their properties. They own these massive real estate properties like the Venetian, the Mirage, the Caesars Palace, all these places on the Vegas Strip that are really irreplaceable. You can't copy these type of places like you can a Home Depot location. You can't just build a box and call it the Venetian. It's not the same. And there's so much logistics and red tape to even build a place like this that it's unlikely to be replicated in the future. So this is a real estate company that I do think has a significant moat compared to other real estate companies. Now, when we look at the metrics of this company, obviously they're growing their revenue, they're growing their free cash flow. We do treat this company a bit different than other companies. For REITs, it's totally normal to have shares outstanding go up over time. In fact, that's what you really expect with any growing real estate investment trust. If you look at Store Capital or Realty Income Corp or Simon Property, all of them will have the shares outstanding go up over time because real estate investment trusts are required to pay out a significant portion of their rent as dividends. And because they don't have as much in retained earnings, the way that they raise capital is by selling shares. They apply leverage to those shares with debt, and then they use that money to buy more properties in what's called an accretive acquisition, meaning that they raise the amount of money that they pay you on a per share basis. So even though the shares outstanding are going up, this is actually still a good thing for the VICI shareholder. And you can see this with the dividend per share paid since the beginning of this company. They're paying you a higher and higher dividend over time as the stock price is increasing. So you're getting both capital appreciation and a growing dividend. And I fully expect them to continue raising this dividend year over year. Now, one of the things I'll highlight on VICI and real estate in general is how incredibly efficient the business model is. Their expenses to run the company, sales and marketing is non-existent. So you don't have a sales and marketing expense. They don't really have any research and development. So you don't need any R&D, and their CapEx spend is incredibly low. Overall, this is an incredibly efficient business to run where they only spend 1 to 2% of their total revenue on expenses. And if you compare that to software companies that need legions of developers, research and development, CapEx spend, sales and marketing, general and administrative, a lot of software companies spend over 50% of their revenue on expenses. VICI spends about 2%. So they're an incredibly efficient business model. So overall, I still love the company. I now like the valuation more. I'm going to keep buying more of this company, especially if it continues to sell off in this market, because I think over time this will prove to be a very attractive company to own. So those are some of the companies that I've been buying in my portfolio that I really think are undervalued. And I know it's depressing to see the market go down. That's our initial emotional reaction. But in reality, if you have a long investment horizon, you should be excited. And honestly, I haven't been this excited to buy these dividend stocks in quite some time. I've been sick of seeing dividend stocks yielding below 1.5%. That's no fun. Now that I'm seeing them yield 3% or above, that makes these companies more attractive. So I'm excited about the future. I'll continue to highlight companies that I've been buying into. And having said that, I hope you all have a great weekend. So that's all for now. I'll catch you in the next one.